Hey everyone, it's Justin here, America's Honest Tax Accountant from Number Crunch Nerds. Welcome to video number 6 of my 10-part video series on tax planning for the year end 2024. As mentioned in video number 1, starting January the 15th, 2025 and running through April 15th, 2025, I will be hosting a 2024 tax return preparation class. There's no better way to learn tax planning than from inside the tax return. So this is where all the action is going to be with me and the channel for the 2025 tax busy season. There's an all new video FAQ on the class, and the link to that can be found in the description below this video. Alright, in this particular video number 6, we're talking about HSA's health savings accounts. In particular, for year-end tax planning, we want to consider the following items. Number 1, maxing out our HSA contributions for 2024. Number 2, the ideal way that HSA reimbursements should work, quote unquote, for future tax planning. Number 3, making the once-in-a-lifetime IRA to HSA rollover. And number 4, getting all of these items into the personal tax planning template. So starting with number 1, maxing out our HSA contributions for 2024. If you have a self-only high-deductible health plan, you can contribute up to $4,150 for 2024, and if you have a family plan, that amount goes up to $8,300. By the way, for each spouse who is 55 years or older in 2024, you can contribute an extra $1,000 per spouse. If we're talking about self-only coverage, then it would be an extra $1,000 for yourself, assuming you're 55 years old or older. Now, keep in mind that these contribution limits up here, this includes your employer contributions as well. It also includes the IRA to HSA rollover, which we will talk about later. So it's a grand total of these amounts up here, these limitations from all sources. But if you have the ability to max this out, this is usually a no-brainer move, because this is the triple whammy tax savings vehicle. You get a tax deduction for contributions made to the HSA, you get tax-free growth, and you get tax-free distributions, including the earnings, as long as the funds are used for medical. Now, I've received emails from a number of folks recently asking, where do we put the HSA contribution in the personal tax planning template? So let's make sure we know how to handle that. Okay, so we're in the personal tax planning template. We're down here in the other income and adjustments section, and I just put in a new row right here, HSA contribution, enter as a negative number, so it would go right here. And the reason we know that is because remember that the other income and adjustments section relates to everything on Schedule 1 of the Form 1040 individual tax return. The health savings account contribution is actually down here in part 2 of that form on line 13 right here, health savings account deduction. So that is what we are mirroring right here with this row. Okay, so now let's do a pop quiz. Let's say that we have the following scenario. Your employer contributes $2,500 to your HSA. You contribute via payroll deductions another $2,500, and then you contribute outside of the payroll system $3,300. How much of the amounts above should be entered into the personal tax planning template? And the answer to that is $3,300. So if we had this fact pattern right here, then I would expect to see $3,300 on this line. Now let's make sure we understand that. Where does this part go? The employer contributions of $2,500. Well, it goes into your HSA, obviously, but is it considered earnings? And the answer to that question is no, it is not considered earnings. This is a fringe benefit from your employer, so it will be excluded from your income on your W-2. However, the amount will appear in an informational box, which is box 12 code W, to show that your employer did that, but this is not part of your income. Now, what about this part? You contribute via payroll deductions, another $2,500. How does this impact the W-2? And the answer is this will be a reduction to box 1. Your earnings in box 1 of the W-2 will be lower by $2,500 in this example. So if we go back to the personal tax planning template, I would not expect to see the $2,500 included right here, because up here on the W-2 line, this number would have already been reduced by the $2,500. So if we were to subtract it out here again, then we would be double counting it. And so that is why the answer in this fact pattern is $3,300. This is what would be entered onto the personal tax planning template. By the way, someone asked me the other day, if you make an HSA contribution outside of payroll deductions, in other words, you just contribute from your personal funds, it's not related to your employer, and that would be like the $3,300 in the previous example. When you deduct that on your tax return, can you also deduct or otherwise get reimbursement for payroll taxes? So just to be clear, when we deduct this $3,300 right here, this is reducing our income tax ultimately, but this is not reducing payroll tax. Up here in box 1 of the W-2, this amount, the $2,500 in our example, that amount avoided income tax and it also avoided payroll tax. But unfortunately, there is no way to avoid payroll tax related to a contribution made outside of the payroll system. So as I said, the answer to that is unfortunately no, and I found a very clear explanation of that here from the HSA store. Right here it says contributions made outside of your payroll system. They avoid income tax but not payroll tax. So when you make your own HSA contributions, you contribute during the year with after-tax money before deducting them on your tax return, which is what we were doing in the personal tax planning template. Right here, when you see this language, regardless of whether you itemize deductions or take the standard deduction, that sentence means you're taking this item on Schedule 1, which we just went over a few minutes ago. But that only eliminates the income tax. There is no mechanism for recouping the payroll taxes you paid on that money. And when you think about it, the reason that that probably is the rule is because there is no requirement that when you contribute to an HSA from outside of your payroll system, there is no requirement that you use earnings that was previously subject to payroll tax. For example, you could earn a bunch of interest or dividend income in a regular brokerage account, and you could use those funds as the source of funds to make your contribution to the HSA. But those funds were never subject to payroll tax in the first place. So if they let you recoup payroll tax on contributions made outside of the payroll system, then you would be recouping payroll tax for which you never paid any. Potentially, anyway, just depending on what source of funds you use to make the contribution. If you used earnings that were previously subject to payroll tax, then unfortunately you're just out the payroll tax on that particular contribution. Okay, next up, let's talk about how HSA distributions should work, and I put that in quote unquote to get the best financial result. And the reason I put that in quotes is because obviously everything is going to be based on your facts and circumstances, but there is a pretty good argument for the way that things should work that we're about to go through. So a lot of people think that if you want to reimburse yourself from your HSA for qualifying medical expenses, that the reimbursement has to occur in the same year that the medical expenses were incurred. And that is not the case. You can reimburse yourself anytime in the future for medical expenses incurred in the past. Just make sure sure to hang on to those receipts. So think about the HSA. It's the triple whammy tax savings vehicle. So ideally, you would want to leave the funds in the HSA as long as possible so interest can compound upon interest with no tax implications at the end, as long as you're reimbursing yourself for medical. In other words, if we look at this timeline, here's, let's say, when you started your HSA, here's retirement out here. If you pay all of your medical expenses with outside funds, meaning not reimbursing yourself from the HSA during this time period, again, make sure to accumulate all of your medical receipts and hold on to them, and thus you let the HSA funds grow for this entire period and then reimburse yourself for all prior year medical later on, you could potentially end up with much more money than if you're reimbursing yourself all along the way. Let's do an example. Okay, so for this example, which looks kind of complicated, but really it's very simple, let's just make the following assumptions: that we have, number one, $14,000 to work with annually. Number two, we have $7,000 annually in medical expenses, so that's $7,000 times 20 years is going to be the time frame for this example, is $140,000 for the life of the example. We're going to further assume that the annual HSA contribution remains constant at $7,000 annually, just to make the math easy. We're going to use an interest rate of 5% in this example, and we're looking at a 20-year investment period, as I just mentioned above. So in scenario one, let's do this. Let's say that we deposit $7,000 in an HSA annually for the current year in order to get the tax break, but then we just reimburse ourselves in the same year the $7,000 to cover our $7,000 of medical expenses that we say we're going to have every year. So just to recap that, $7,000 goes into the HSA, $7,000 comes right back out of the HSA to cover medical. So that's half of our 14, and the remaining 7 gets saved in a regular interest-bearing account. So that's scenario one right here. I start with $7,000. If I click on this cell, you can see I'm growing that by a 5% rate of return. We take the difference, that's our gain. We're going to assume a 24% tax rate, so 24% tax on the gain. And then we're going to take the balance, including the growth, we're going to subtract off the tax and get the closing balance. And I need to correct that right there to say closing balance. So then right here, we take the closing balance from the previous year and we add another $7,000 contribution. Same 5% growth rate applies. We take the difference between this number and this number. That gives us our taxable gain on this return. 24% tax on that. And then we take this balance right here, less the tax, and we end up with the closing balance of $14,808. And that continues year after year. We're doing the same thing until we arrive at the end of the 20th year with $211,932 in this account. Now back up here in scenario 2, we deposit $7,000 in an HSA annually for the current year in order to get the tax break. So that's exactly the same as scenario 1. But then we leave the money in the account so interest compounds for the full 20-year period. And because we're not taking the money straight back out of the HSA to cover our medical, we pay our $7,000 of annual medical expenses with outside funds. And again, that's just the other half, the other $7,000 of our total $14,000 per year that we're working with. Okay, so right here in scenario 2, this is much simpler. I start with $7,000, I apply my 5% growth rate. Then I take my ending balance from here, I add $7,000, I apply my 5% growth rate, and on and on and on, until we get down here to the 20th year and we have $243,035 in the account. So to compare these two scenarios, at the end of the 20th year, I have $243,035 sitting in the HSA right here, versus $211,932 sitting over here in a regular brokerage account. Over here, I have collected my $7,000 of annual medical receipts, and so I reimburse myself for the entire amount, which was $140,000, and that leaves a remaining HSA balance right here of $103,035. Over here, there's nothing to reimburse because we already took all the money out of the HSA year by year. We just distributed $7,000 to cover that year's medical expenses. So here's the final comparison. For scenario number 2, after 20 years, we have $140,000 of cash available for any purpose. Because remember, after you reimburse yourself this $140,000, that $140,000 is then available for whatever you want. And then we have $103,035 of cash available in the HSA for medical in our retirement years. Over here in scenario 1, on the other hand, after 20 years, we just have $211,932 of cash available for any purpose. And the difference in total cash right here, which if I click on this cell is just the difference between this $243,000 versus the $211,000 over here. This is how much you are ahead in total cash between these two different scenarios. So which one is better? Well, as I always say, which one is better is up to you. Which one is better? It depends. Would you rather have $31,000 more total cash, but only $140,000 of it is available for any purpose and $103,000 is specifically earmarked for medical? Or would you rather have $211,000 in cash available for any purpose? Only you can know the answer to that, which one you would prefer for your facts and circumstances. So it's not better, it's just two different approaches for you to consider as we go through our ongoing tax planning scenarios. Okay, so next up, making the once-in-a-lifetime IRA to HSA rollover. So I got some good snaps from Fidelity here. Moving money from an IRA to an HSA comes with a host of rules and can typically only be done once in a taxpayer's lifetime. As all of you know, left in a traditional IRA, you'd likely have to pay income taxes on distributions even in retirement, whereas money in an HSA, on the other hand, can be withdrawn tax-free for qualified medical expenses. So for those people who have an HSA and are on the appropriate type of high-deductible medical insurance, doing the once-in-a-lifetime IRA to HSA rollover is most likely a no-brainer move if you're going to incur at least, let's just say, $8,000 in medical expenses during your life, right? Because if you're just going to take, let's say, $8,000 out of your IRA directly and use it to pay for medical expenses, then it would certainly be a no-brainer move to just roll it over in one particular year to your HSA first and then take the money out to cover medical expenses. In addition to that, as most of you know, on this channel, we talk heavily about doing Roth IRA conversions in order to reduce future RMDs. So if you do an IRA to HSA rollover, then the money coming out of the IRA is not taxed. So every opportunity that we can find to get money out of a traditional IRA in a way that's tax-free will help reduce RMDs in later years, at least by a little bit. I mean, that's like $8,000, let's say, that we can get out of our traditional IRA tax-free and get it into an account where it can also be used tax-free as long as it's for medical. I wanted to point out this paragraph right here. It says HSA contributions that are made through an IRA to HSA rollover are not tax deductible. Okay, that's true. So in the current year, you're not going to get a tax deduction for that. Such a rollover would reduce the amount you can contribute to an HSA for the given year. We talked about that. Remember I said up at the top that these thresholds right here, this is a grand total from all sources that would be contributed to your HSA for the year. So that includes your contributions, employer contributions, IRA to HSA rollovers. It's one lump sum total that can go in. But then it says right here, but would not otherwise be expected to impact your tax situation. I think that's kind of an incomplete thought right there. It will impact your tax tax situation a little bit in the future. It will help reduce your RMDs by getting money out of your traditional IRA in a tax-free way. So if you're thinking about this and you think it might be a good idea, and it probably would be if you have an HSA and it doesn't have a particularly high balance, in other words, the amount of medical you're probably going to incur over the remainder of your life is in excess of whatever the balance is in your HSA, then it most likely would make sense for you to do this one-time rollover and just find a good year when perhaps you don't want to contribute from outside funds. Maybe you're using all your outside funds for some other purpose in that particular year, and so that would be a great opportunity for you to do the rollover in that year. Make sure to read the rules about this before you do it. There's a couple of rules like this testing period right here where you have to remain enrolled in an HSA eligible health plan for 12 months post rollover. There's also this down here, if you're going to do this post 65 years of age, there are some Medicare Part A lookbacks to be aware of. I'm not going to jump into the details of all of those rules of doing that right here, but I wanted to make the point that since you can only do this once in your lifetime, there is likely no need to rush to do it in 2024, and therefore you have the time to learn the rules and time this transaction as most appropriate for your situation if you believe this is beneficial to you. Okay, now how would we incorporate an IRA to HSA rollover into the personal tax planning template? So to accomplish that, we're going to be right over here in the Roth Conversion Tax Strategy tab. I'm going to be right up here in this new column called HSA Rollover or QCD. Enter the item as a negative number. We're going to cover QCDs in detail in the next video in this series, but this column is going to be for items that we can take out of our traditional IRA that don't create any kind of taxable income or taxable situation. So for example, if I go into this cell right here and I just put in 8,300, you can see that when I click on this, it's taking the sum of our account value after all the growth plus contributions and distributions for that particular year. It's subtracting off our RMDs, although in this year there isn't one, but if there was a number here, it would be taking that away. It's taking out any actual Roth conversion that we do, and then it's taking out any HSA rollover or QCD coming out of the traditional IRA. And of course, any number that we put here, whether it's an HSA rollover or a QCD, will reduce this ending balance and thus will reduce RMDs in future years. Okay, so that's going to be it for today's video. Make sure to tune in for video number 7 of this series where, as I just mentioned, we will cover QCDs, qualifying charitable distributions from your traditional IRAs. Again, as I mentioned, this is yet another way to reduce RMDs in the future while also supporting your favorite charitable organizations. Also remember that sign up for my 2024 tax preparation class is now open. We're going to learn tax planning from inside the tax return as we prepare our 2024 filings. Also, there is now a video FAQ about the class, the link to which can be found in the description below this video. Thanks everyone for watching, and I'll see you next time.